Canada just posted its highest apartment vacancy rate in over 10 years, right as rent growth flatlined. If you're a landlord or investor in 2026, this could be a warning for you. This data comes from Yardi's quarterly Canadian National Multifamily Report, and vacancy in Canada is now the highest since they've started tracking it in 2020. Major cities like Calgary, Edmonton, Montreal, and Hamilton all have vacancy rates over 5% and are loosening pretty quickly, with Calgary actually at 6%. New lease rent growth collapsed to just 0.7%, down from 6.4% a year prior, and new lease rent growth is actually negative in large CMAs. In Toronto, Vancouver, Calgary, and Hamilton, rents are actually falling on new leases. Turnover is rising and people are staying longer, but more units are sitting empty. Investors in 2026 face one of the toughest underwriting environments in recent memory and probably one of the toughest operational environments. So make sure your deal modeling reflects today's rental market, not last year's. Either subscribe here or head over to realist.ca for tools, dashboards, a deal analyzer tool, and a bunch of data that'll make your life a lot easier as a real estate investor. Now let's start with the hardest truth. 2026 opened with the loosest rental market in over a decade. And Canada's apartment vacancy rose to a decade-long high in Q4 of last year. We have Calgary at 6.1%, Edmonton at 5.3%, Montreal, Hamilton at 5%, Toronto and Vancouver over 4.5% vacancy, which means their vacancy rates have almost tripled since their bottoms. And vacancy increased year over year in every major market. National turnover hit 25%. And in some places like Calgary and Saskatoon, it's over 40%. Even a soft landing in rent growth can turn into a hard crash in cash flow when vacancy creeps above 5%. Now, in-place rent growth is also decelerating, but still moving up 3.2% year over year, the smallest increase in over 4 years. And Calgary is now in negative territory with a 1.3% year over year rent decline on year over year in-place rent growth. The best performers would be Halifax at 6.1%, Montreal at 4.1%, and Ottawa at almost 4%. Now, this is where it gets dangerous for investors underwriting increases in rents in their pro formas right now. I host the Canadian Real Estate Investor Podcast, which is Canada's #1 real estate podcast. And the big hot type of real estate investment for people right now is buying these pre-made CMHC MLI Select deals coming out of like Edmonton and Calgary as an example. And I represent a lot of people who are looking to do these deals as clients, right, as buyer clients. And on the debt and equity side, I look at like hundreds of these pro formas a month. So basically like financial models that show me what the listing agent or the developer thinks the deal is going to do. And I haven't seen one with vacancies where they are right now. I didn't see any last year stress testing a doubling of vacancies or much less a 3x of vacancies. And I still am not seeing any of them capturing rents falling in the model. Like nobody's forecasting for rents to fall for 2 years. It's not to say that these assets won't be fine in 3, 4, 5 years when rents stabilize and maybe start growing again. But they're so high leverage. Like people are buying these deals with like 95% loan to value. So they're only putting 5% into the deal or 10% into the deal. And so the margins are so tight. Plus they're on a 50-year amortization and they only have to hit a 1.1 to 1.2 debt service coverage ratio, which means like you're only 10% cash flow positive. So on closing, if you don't stabilize to the rents that you thought you were going to, or your vacancy's higher or rents have fallen, you got very razor thin margins on how much room you have to fix that problem. This doesn't really matter if you're a massive institutional landlord, right? But it does matter a lot if you're a pre-con speculator who's just doing this because it's the highest leverage that you can get and the least cash that you have to put into a deal to make a real estate investment. For the large institutional landlords, honestly, most of them don't really care about what's happening with vacancy or rents if they're using CMHC, MLI Select financing because they're functionally bond traders, right? Like on a 50-year AM, for the first like 5 to 10 years of your mortgage, like 80% of your mortgage payment is interest. And so, yeah, your net operating income, your income that pays the rents matters, but it doesn't matter nearly as much as what's happening with the mortgage bond because if your interest rate goes up, if the mortgage bond yield goes up 50 bips, your interest rate goes up 50 bips or 100 bips, that's a way bigger swing on your monthly cost or on your net operating income than anything else we'll discuss in this report. So that's part of the fascinates me the most about this whole thing, is a lot of people don't even really give a shit what I'm saying in this report, because they honestly just care most about what's happening with the bond market. Now, national new lease rent growth, so lease over lease, which basically means that you're getting rid of a unit somebody's vacated a unit and you rented it at $2,000. That's your first lease. And then they vacated and now you've released it at $2,100. The jump between those two numbers is a lease over lease rent growth. That number is just 0.7% and down from 2.4% in Q3 2025. So not only is it falling, it's falling pretty steeply. And Ontario is actually negative across multiple CMAs. So you have Toronto here down 1%, Vancouver down 2%, Kitchener-Waterloo, Cambridge 2.5%, and Hamilton not down so bad. Calgary is down the most, over 4%. And unironically, that's one of the places that I was mentioning. You're getting a lot of these Toronto pre-con speculators piling into these CMHC MLI Select deals. Now, they mentioned that condos failing to sell are flooding the rental pool and non-permanent resident caps are slowing demand. I just did a video on that, so make sure you check it out. There should be a link at the end of this video to my most recent video. And so your new supply pipeline, the flood of new rentals that we're seeing coming, and I've done a bunch of analysis on this on the channel, so just go look at any of my past videos on that. Probably the best one is with Brian Yu from Central One Credit Union, who did a very thorough analysis on the coming rental supply wave. All of these projects were contemplated on the assumption that non-permanent residents growth, or at least the number of non-permanent residents, would stay where it was. And so that's changed, and now you still have this, people aren't going to stop building their projects because the input changed, right? So a lot of these buildings are stabilizing into a much worse environment. And in markets like Calgary, Edmonton, Saskatoon, the turnover rate is 40% with rising vacancy. Even Toronto's vacancy rate jumped to 4.6% with turnover still low at about 16%, but rents are falling. Halifax and Ottawa, two of the most affordable markets in Canada relative to house prices and income, or rents and income. Those are two markets that are still seeing net positive rent growth and pretty stable vacancy. Now, this is where it gets really spicy. If you look at bachelor units specifically, bachelor unit vacancy in Toronto is 8.7%, Hamilton is 14.5%, and Calgary is 8.3%. Okay, so your tiny units are having the hardest time leasing. One bedrooms seeing a similar softness, but not as severe. Toronto, 4.8% vacancy for one bedrooms, Calgary, 5.4%, and Hamilton, 5.8%. Now you get to your 3-bedroom units, and this is where you start to see some resilience, okay? So nationally, they're seeing 2.4% rent growth for 3-bedroom units, and even Toronto is up 2.3% on new 3-bedroom leases. So your micro units aren't renting, and families aren't moving. If you're holding small product, I think you ought to be prepared for higher turnover and lower rent growth. Larger units might do a little bit better. Now, vacancy has been rising every quarter since Q1 2024. In-place rents have plateaued in Q4 of 2025. And new lease rent growth is at its lowest since pre-COVID, dipping below 1% for the first time since 2020. Average national expenses in 2025 are about $8,000 per unit per year. Ontario tops the list at almost $9,000, followed by Alberta at just over $8,000. So we can see that even landlords are getting hit with the inflation on services that it take to run a property. Repairs and maintenance alone are $2,000 plus per unit in some provinces. If you want to download these charts or plug these expenses into your own models, go to realist.ca. We've got deal analyzers and rent trend dashboards built for this kind of market. Anyway, to finish up here, the Canadian rental market is cooling sharply in 2026. Vacancy is climbing and rents are stagnating or even falling in core markets. Tenants are staying longer, but units are still turning more often, and landlords are absorbing longer lease-up times. Landlords and investors need to reset expectations, model their deals properly, and adjust deal criteria accordingly. Hit the subscribe button if you want data-driven takes like this every single week, or join me at realist.ca for free tools, meetups, and the Realist Roundtable, which is a weekly call where I have conversations just like this one with a group of investors from across Canada. I'm going to leave you with a question, as I always try to. Let me know your thoughts in the comments. I try my best to read and respond to every single comment on these videos. Sometimes I do better than others, so I apologize if I didn't get to one of you. But let me know what you think. Is Canada heading into a full-blown renters market in 2026, or is this just the reversion to normal? And how much downward pressure do you think this is going to have on house prices and the housing market, which is what everybody wants to know at the end of the day? Anyway, thanks a lot for taking the time to watch this video, and I'll see you again as soon as I can.